Should I hit record?
Oh, sure.
Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Excited to be back here in studios for today's podcast. A lot of news has hit the tape, so to speak, this morning, and a lot to look forward to in the coming days and weeks.
Yeah, the Beige book has hit the fan, the proverbial Beige book.
I don't know where they came up with the name Beige book. We didn't do any research on that prior to this, but it seems like a very interesting name.
Yeah, I'd like to think that, I don't know. Maybe Greenspan was just a big fan of like 50 Shades of Grey series, and he was like, I got to come up with something that's like economically appropriate, but he just wanted to lift that title.
I think they're just trying to keep it very vague. Like, who wants to read the Beige book?
Yeah, that's true. It also makes you think of like food court at the mall. Like everything is that one color, you know? Right. Or when I go back and visit my mom and stepdad and I sit in their house, it's just also phrase of beige.
Well, we're going to talk about that today. And I wanted to start with the news that hit the market. But before we even get into that, there might be some folks watching this for the first time. Welcome to the show. Thank you for watching. Please like and subscribe it on the YouTube page. And the reason why we do all this stuff is, you know, it'd be great if one day we look up and you might have to start putting on makeup before the show is, and maybe there's like 1 million people tuning in live, like on the Joe Rogan podcast. That would be cool. That's not the point of this, though. I'm not discouraging that by any means, because this is a lot of fun for us. Mm-hmm. And the main purpose of doing all this is I got the chance to speak to a bunch of people at a nonprofit organization a couple Fridays ago. Oh. And I just, all of them are business owners in the Cincinnati, Northern Kentucky area. And I asked them all, I said, hey guys, I know you all are investors, either in your retirement accounts or just in general. A lot of you probably see the news just like I do and all my other clients do. They're talking about, inflation still sticky. You got unemployment, it hasn't really changed a lot, but people are laying off people in the tech industry. You're seeing the Silicon Valley bank crisis in the financial sector. You guys see all these headlines, right? Every one of them. Yep. Hey, curious though, before we get started today with today's conversation, how many of you think the market's down at least 5%? Everybody's hand shot up.
Everybody.
The truth is the tech sector is up 15% year to date, and the NASDAQ's still up more than 7% year to date. And you wouldn't know that if you just strictly look at the headlines, and all of them were shocked. And I told them all, the reason why I do this show, the reason why we send out the newsletters, the reason why we do the podcast, the reason why we started doing the blogs every Friday is simply due to the fact that I know that you all are watching the news just like I am, just like clients are, just like human beings are. And the news does a really good job of doing their job, which is getting people to, stick into their programs and watch them religiously. And they do that by placating the human being's emotions. We're all hardwired with this thing called fear and greed. You can literally get a PhD on the topic of behavioral finance. It's just a study of how people make decisions with their money. Mm-hmm. And the news understands all this. They do a great job of not knocking the news. That's what they're there to do. What we're here to do is to tell you what's going on, but provide that with some historical context, because it's almost never the first time that this economy here in the United States or the global economies went through these events. And if you look at what history has to say about similar events and the outcome that came about later, 3, 6, 9, 12 months down the line, now you can start to formulate some real logical game plans here with the portfolio to take advantage of that or to protect yourself, whatever the circumstances may be. So that's the main reason why we do this show, is to provide you guys with some historical context and therefore a game plan going forward. And we've been right. We've been talking about the tech sector, overweighting that since Q4 of last year. Yeah. We talked about rebalancing out of the things that did well last year in 2022. There wasn't a lot. Healthcare and energy was pretty much it.
Yeah, I do remember those podcasts. And for anybody who's listening, they're archived on the YouTube page, so you can go back and see.
You don't have to take my word for it. You can literally, there's video and written evidence that we've been talking about this for a long time. Yeah. And that was not consensus, by the way. Mm-mm. Coming into this year, everybody's like, stay long energy, stay long healthcare. Tech's going to be awful. Like all the same things that were awful in 2022 has been the exact opposite.
It has. Yeah.
And we've been fortunate enough, based on the research, the work that we do, looking at what history has to say, is the only reason why we've been able to capture this kind of positioning. And therefore, the fruits of that labor are now starting to show up in people's portfolios in these quarterly reviews. So we're super excited. I freaking love doing this. And I have a lot of fun with it.
Me too. I mean, we're friends and family outside of this. So not only do I look forward to being able to spend time with you, even though it is at work, but yeah, I've come to look forward to doing this a whole lot. My expertise, shockingly, is not in finance. I'm still trying to find what that expertise is, actually. But,
I think we do
high graded on a mic's pretty good so far.
Absolutely. Great job of the video editing, all things that I'm not good at, art, basketball, and UFO information, crypto stuff. Like you got the things that I don't got, man. That's why this works.
I appreciate that. You just painted a portrait of somebody that I would swipe right on, so thank you. But speaking of hype, man, this might be a good time to talk to the viewers. You may have about the stream time we have linked today. You got a client calling in possibly?
A prospect, actually. Guy I've met a couple times for breakfast, business owner. Very, very excited to take his phone call. So yeah, I know we're doing this on YouTube Live, but the reality is, not am I just a certified financial planner, but I'm here to run a business. I'm here to support clients. I'm here to take people that don't have the resources that we have. They're trying to do it themselves and put them in a much better situation. So I may have to take a phone call here in just a little bit from a new prospect, and you're looking forward to bringing him on board. I'm going to go over some next steps with him. So I might hop off the hot mic here for just a second, take a real phone call, and jump back right in here with you guys because that's just what I do.
Yeah, so listeners, we're going to make an audible on that whenever it comes. We may either pause the stream or if it's going to be a very brief call, I may just talk your ear off about, yesterday's Senate/congressional hearing on UAPs and the lack of funding for the Aero project.
Well, I was going to say, too, I know that you follow Tesla, maybe not the stock as much as the company and Elon.
And the tech. I mean, I'm a pretty big proponent of solving a lot of problems with EVs if we can. So.
Tech, specifically Tesla, shares are down 8% on the back of their earnings announcement last night after the market closed.
Yeah.
I don't know if you caught that or not, but
I did.
It all had everything to do with their gross margins falling from what analysts had expected. And really, Tesla set analysts up, to expect 20% gross profit margin.
Yeah.
They said that last quarter in Q4 of 22. And it came in at like 19%, and the shares are off 8%. Now, I have my take on it. I'd love to hear yours just before we get into the meat and potatoes of today's show.
Well, for me, it starts at the top with the CEO. And I think, you saw the first signs of Tesla shares wavering when Musk wanted to purchase Twitter. And it certainly isn't meant to be Monday morning quarterbacking or looking in hindsight. But even back then, folks were wondering how he could be CEO of three companies that required 24/7 attention: SpaceX, Tesla, and Twitter.
He also has this boring company, boring,
which I think is folded, right, or is no longer a thing.
I'm not for sure on that. Obviously, it's private, but
something was going on. I can't. That's a different topic. But I feel like I heard that the contract they had to build the new San Francisco tunnel, I think that they didn't get it, and the company's not going to be a thing anymore. Something like that.
Well, my take on the actual Tesla share announcement, I was actually not surprised that the stock sold off because of the news, because that's what everybody wanted to look at, right? It wasn't how much better are we at the manufacturing process, how much market share that we're taking, yada yada. Everybody's looking at that gross margin number there. But to me, it's smart. This guy's playing chess. And, I think the people that are selling the stock here this morning are maybe the worst checkers players out there. Like Elon's thinking, okay, I've already got Ford, GM, all these other competitors in the EV space. I got them on the run. I am actually profitable making electric vehicles, and you guys suck at it. So what I'm going to do is I'm going to drop the price a little bit, but I'm going to offset that drop in actual price per model. And they're making that up with more efficiency, specifically on the battery, right? With the plant that they have now in Germany, the plant that they have going on in China, the plant that they have in Austin, Texas. They're going to make up that drop in actual price via efficiencies, and specifically a third of the cost of a Tesla vehicle is coming from the lithium battery itself.
Right.
So if they're able to reduce that cost, that offsets that, and you probably are still going to see margins. Well, first of all, the margins are still going to be vastly better than everybody else that's trying to catch up with Tesla in the EV space. So we aren't heavily overweighted Tesla. We have a few accounts that, they're comfortable with the volatility on that.
Mm-hmm.
A lot of clients aren't, and that's the big reason why we don't have a lot of Tesla. But looking at it from a fundamental and strategical standpoint, trying to project out, it's hard to get in Elon Musk's brain, but I can actually see kind of the game plan that he has here for the companies, dominating the market share in the EV space. So
yeah, I mean, we'll see if that continues with the Ford Ranger coming out and the Tacoma, and
we'll see.
Like what I was saying, it starts with him. I feel like that if he can kind of get his overselling, under performing kind of recent track record under control, and I think Tesla's going to rebound. But he's overpromised all of these aspects of Tesla, which being the only car in the market. And it's not like you couldn't find a Tesla if you wanted one, right? It wasn't this like hyper obscure brand. It was like you could get one. Well, but the autopilot doesn't work. They're not driverless cars. The customer service is atrocious,
right?
And you find all these people that say like, yeah, buying a Tesla is the best decision I ever made, but only because it's an EV, not because it's specifically a Tesla,
right?
So I think that unfortunately Musk's like over-promising, under-delivering is kind of coming back to bite him. And what you're seeing not only is a result of some of those things you just talked about, but also consumer reports are kind of catching up with him. That doesn't mean that Tesla's going to go away. Even with Ford and Toyota in the market and Rivian, there still is a place for Tesla, and they may end up, electric cars may end up being just called Teslas, like we call an MP3 player, an iPod, or, soda's Coke or something like that.
Well,
but that's my take on it, is that it starts with him, and it really, unfortunately, is a lot of this over-promising, under-delivering, and then not taking the time to craft the company that's needed to take care of the consumer base, for recidivism.
We'll take a look at it over time here, but I'm not betting against the guy long-term, that's for sure.
No.
So we'll keep an eye on that. Now, getting to today's news, we got initial jobless claims came in just a little bit higher than expectations. The median forecast for economists was 244,000. Initial jobless claims, it came in at 245,000, so just a tick above the median expectation, which actually, bad news is kind of good news in this regard. If you're looking at it from a Fed perspective, they're trying to slow demand. And this is one of the ways in which they do that is by affecting people's employment, which is a political debate to say the very least. Now, the continuing jobless claims increased quite a bit from the prior month. The prior month, we were looking at 1.8 million continuing jobless claims. Now we're at 1.87 million. So I think the Fed will obviously take that into consideration before their Fed announcement on May 3rd. Now, looking forward to next week, we're still in earnings season, very beginning part of earnings season. It's been a really good start thus far for earnings. If we're looking at earnings thus far, 82% of companies are beating, and they're beating by a margin of 7.6%. So this is definitely better than feared. And in fact, earnings per share forecast have slightly increased, just a tick, which was the big fear coming in this year, is everybody's going to say, hey, the earnings are going to fall off a cliff. Well, we're still very early into earnings season. Less than 20% of publicly traded companies in the S&P 500 has reported, so it's still early, but the numbers are great and certainly not falling off a cliff. Looking forward to next week on the 27th, that's next Thursday of April, we get GDP data, which is a big one. We also get more jobs information, initial jobless claims. The very next day, we get the Fed's favorite inflation measure, which is PCE, specifically core PCE. So that's coming out on Friday the 28th, which is literally right before the very next week, the Federal Open Market Committee meeting on the 2nd and 3rd. On the 3rd, Fed Chair Powell is going to come out and say, this is what we think about the economy, and therefore this is what we're going to do with interest rates, whether we're going to keep it the same, not raise. They're certainly not going to cut. That would shock the hell out of everybody. And then, of course, we got all the big tech earnings coming up next week as well. So the 27th, we got Amazon coming out. On the 25th, we got Microsoft and Google. May 4th is Apple. May 24th, we have NVIDIA. So some of the bigger tech names out there. And then May 6th, very, very cool. May 6th in Omaha, Nebraska, we got the annual shareholder meeting for Berkshire shareholders. Buffett himself is a ripe 92, and Charlie Munger, his co-chairman, is 99. Taking questions. And he's awesome. He just tells you exactly how he feels about whatever.
Kicking names and taking ass. That's the job.
They've been doing it really, really well for a long time.
Yeah.
Which I actually want to talk a little bit about that here in just a second. But I wanted to get into the Beige book information here just a little bit. And again, I wish I would have done some homework as to how they came up with that name. I'm very, very curious now. But the Federal Reserve released its latest Beige book report on economic activity today. The report said overall economic activity was little changed in recent weeks. Employment growth moderated slightly. We saw that in the numbers. And overall price levels rose moderately as the rate of price increases slowed. So what does this really mean? According to Jeffrey Roach, who's the chief economist for LPL Financial, the upside for the picture painted by the Beige book is the Fed will have some leeway to cut rates by the end of the year as inflation moves closer to the Fed's long-run target. And investors should anticipate a positive move in risk assets. I will tell you that I am in agreement with this. I think this is not consensus. If you look at the significant levels of cash in brokerage accounts, as well as for institutional investors, highest we've seen even going back to 2008. So that's another tailwind for equities, assuming that earnings continue to hold up and inflation continues to moderate and fall. That means less Fed pressure on rising rates, which should be a very nice rally all the way through the end of this year and into next year, which is what we've been talking about for months now, going back to October of last year. So we are definitely not on the consensus camp, which is Fed's going to basically continue to increase rates to cause this major recession and earnings are going to be terrible. That's where most people's money is, in cash. That's why they're talking with their investment dollars being in cash. We're the exact opposite of that. We're nearly fully invested, significant overweight in technology. And thus far this year, we've been on the right side of that trade. But if we look at the Buffett news that came out here not all that long ago, actually right before we got on the show here today, I'll pull that data up. So Jeff Bezos, obviously chairman of Amazon, pretty successful businessman. He had asked Warren Buffett this very simple question. He said, your investment thesis is so simple. You're the second richest guy in the world, and it's so simple. Bezos asked Buffett, why does everybody not just copy you? It's a good question, right? I've been trying to do that my entire career.
Yeah. I'm going to be honest with you. I thought his question was going to be like, do you want to fight? But that's even more, perceptive. Why don't we?
That's like Celebrity Death. Remember that back in
that claymation show?
Yeah.
Back when MTV was good.
Yeah. Different topic. But anyway, so here's the answer that Buffett had for Bezos' very simple question. Why doesn't everybody just copy your style? And Buffett said, because nobody wants to get rich slow. That's one of Warren's many admirable traits. He's earned all this money without having an opinion about where markets are headed in a given year. He just holds great businesses. That's beautiful.
Yeah, that is.
And Charlie Munger, he backed him up and said, it's a recipe for mediocrity when entering and exiting positions. However, that's so humble because if you go back to 1965, which is when Buffett and Charlie kind of, took over Berkshire.
Yeah.
Their performance is 20%. The S&P over the same period of time is 10. So they did not get rich quickly. Most of Buffett's net worth was made after the age of 65. He had $1 million next to his name net worth wise when he was 30, which if you extrapolate that in today's dollars, it's more like close to 10.
Yeah, I was going to say because you got to put inflation on that.
But the bulk of his net worth has been made past the age of 65.
I feel like just due to their age, that's the equivalency of them answering Bezos with, don't make me take off my belt. Humble, eloquent, but still just kind of like, don't make me take off this belt.
Absolutely. And he gives some really good, information here, but it's not like information. It's more or less just his logic about how he handles things, because he's always constantly asked, like, hey, what is the market going to do? What should the Fed do with interest rates? And he's always given the very straightforward answer of, I have no idea what the market's going to do over any given point in time. But what I do know is I'm going to sit here in my office. I'm going to read all day long. I'm going to read and think, and then read and think some more. And that's how he goes about making his decisions. He's more looking at it as being a business owner versus being a trader or a speculator.
Yeah, I'd say that.
And he's 100% right. Like if you and I, Ez, were to have some sort of successful McDonald's franchise, just as an example, right? We wouldn't give a damn about what interest rates are going to look like over the next 6 to 12 months.
No.
Most likely. We're going to be worried about, do we have the right people? Are we being efficient with the employees that we have here in the office?
Yeah.
And yeah, you might have a bad year, just like farmers. You know, if you're a farmer for 50 years, you might have 5 to 10 years of bad weather.
Yeah, you can't control that.
But if you got 45 to 40 years of excellent, types of weather conditions and you're able to produce, okay, yeah, you had to go through some bad times too, but that's just part of life.
Yeah. Yeah, that's just the breaks. I mean, you can make that analogy for any business.
Exactly. So I just love the simple nature that he takes to things, and he definitely does not speculate. He sits down and does a lot of reading before he'll ever pull the trigger on any one particular investment, which he's done obviously a great job of over a very long period of time.
Yeah, Buffett wasn't someone that I had. Obviously I knew who he was. I mean, I would say, maybe not a household name, but even if you don't know what Warren Buffett is actually responsible for, then, you've heard his name, I feel like, just through pop culture, right? But the more and more that I hear you talk about, the reasons why you admire him, I just get more impressed with what he's been able to do for himself.
It's amazing. And what he's done for shareholders is absolutely amazing. So I wanted to give you guys some historical data here too. We talk about the historical stuff a lot.
Yeah.
So first of all, it's tough to be a bear in April, specifically pre-election years. Specifically pre-election years. Let's see here. The average gain for April and pre-election years is greater than 2.6% going back over 90 years. And this is proven to be the second best performing month historically behind January. So it's very difficult to be a bear in April pre-election years, and you're still seeing that fight every single morning. The futures are almost always down. In the last couple of days, we've seen to claw our way back to even or slightly positive. So we wanted to provide the historical relevance to that. But if you actually look at the technical analysis of the market, which I'll look at it, we should probably distinguish between fundamental analysis and technical analysis real quick.
Okay.
So fundamental analysis, that's going to be more of your Warren Buffett style. You're looking at book value, price to earnings ratio, earnings per share growth, all the things that you would get from financial statements, balance sheet, income statement, cash flow statement. That's typically your fundamental analysis. And really what you're trying to do there is say, okay, based on the fundamentals, the book value per share, the return on equity, do we have a company here that's undervalued relative to what the market stock price is showing? And if it is, then it's a great opportunity to acquire shares of that company and look forward to the rest of the market catching up with the research that you've now done. Now, from a technical analysis standpoint, you're not looking at any of that stuff. You're strictly just looking at the price action of the shares and comparing that to their historical moving average. Typically, a 50-day moving average, 200-day moving average is what's most commonly looked at. And what you're trying to determine when you're looking at the technicals is, do I have a good entry point relative to the most recent price action over, let's say, a 3, 6, or 9 month period of time, whatever you're looking at. And that might give you a good technical look into, okay, if I step into the stock price here at its current price, technically I feel good about it because it's trading below, let's say it's 200-day moving average, and we kind of expect that to revert back to the mean, if you will. So that's the difference between fundamental and technical. Generally, if you're looking at the fundamentals, it's probably more of a long-term, I'm going to buy this, I plan on holding it for a very long period of time. Technicals are just telling me whether or not I might have an attractive entry point or not. And I might just be looking at technicals just for a short-term trade, right? Get in, get out. Considering that right now in metals, actually. Metal charts are looking pretty good for April. I'm not a long-term investor in that space just because it's so fickle with supply and demand, but it is something that we're taking a look at here. So we'll provide more context for the viewers if we decide to pull the trigger on that. Now, let's take a look at the S&P 500 technicals. So we've been staying above the 200-week moving average for quite a while now. The S&P 500 has been above its 200-week moving average for 25 weeks in a row. And on October 12th, 2022, the S&P 500 touched this level and has now since moved higher. Now, why is that important? In the 12 instances of crossing above the 200-week moving average and staying there for 25 weeks, the S&P 500 is higher 12 out of 12 instances for all periods. 1 month, 3 months, 6 months, and 12 months later, the S&P 500 is higher when this happens. So doesn't this sound like a bull market for all the bear people that are out there watching the show, watching CNBC, selling shares? This feels like a bull market to me.
Yeah.
Right. You've had 2 consecutive quarters, Q4, Q1, of positive GDP. We've never had a bear market under 2 consecutive positive quarters from a GDP standpoint. Now you got the S&P staying above its 200-week moving average for more than 25 weeks, but yet you still have people calling for the S&P 500 to essentially lose 20% from where it's currently trading at today due to the concerns with earnings not holding up and the Fed is going to continue to tighten. Now, I'll even go back even further here with the data. Now, how do we arrive at this 25 weeks based on, all the other times where you might have had the S&P 500 above its 200-day moving average? Since 1957, there have been multiple crosses above a 200-week moving average, but many failed and led to new lows, which is not what we're seeing right now. The longest of these fake recoveries was 13 weeks. And that's the reason why we use 15 weeks as our threshold here.
Oh, right on.
So now, like I said, that has happened 12 other instances, and the S&P 500, 12 of 12 times was higher 1 month, 3 months, 6 months, and 12 months later. Now, leading the way of all of this are FANG stocks and technologies. Again, that's our favorite sector going into the year. None of those things have changed. And so far this year, financials, utilities, healthcare, they've all lagged, and they've far lagged technology. Now that may change here short term. We're starting to see a little pop in healthcare as an example, but the data that I'm looking at, I have a very hard time feeling bearish here, right? And we talked about this in our last podcast. I wrote about this in our last newsletter, is that we've had, this rule of the first 5 trading days we've talked about all year long. And what does that look like? The rule of first 5 trading days looks at years when the S&P 500 gains more than 1.4% in the first 5 days after coming on the back of a negative year. So 2022, negative year. Now, this has also happened historically 7 times since 1950. And based upon these 7 years, April's implied gain of about 4.2%, I expect that to happen, and was positive 6 of 7 times. And we would expect the S&P 500, for all those that are, making predictions out there. Most people are calling for the S&P 500 to never really exceed really where we're at right now. Most people's best case scenario on the bear camp is we kind of go sideways for the rest of the year. Where all this historical data is slapping you right in the face of all those comments here. We actually would expect the S&P 500 to be above 4,200 before the end of April, which again is wildly against consensus, but we're all going to find out together. The numbers will prove themselves over time, and I will gladly take all the criticism that comes with that if we're wrong, but I'll certainly be the first to say I told you so.
As you should. It's not petty if it involves the market.
Yeah, and if it's true, it's not bragging, right? I mean,
yeah,
let's just call it for what it is. So those are some of the highlights of all the data. Very much looking forward to the remainder of earnings season here. We kick off big tech next week. And I don't think we really learned a whole lot from the Beige book here, in this particular report.
No. And yeah, I can't even. They got to come up with a new name.
Yeah. Well, I mean, we don't even really know how they came up with that name anyway.
I mean, maybe they were all wearing khaki.
Well, we'll get a chance to see it all at the same time here together, unfortunately. But it'll be what it is.
Yeah.
Now, those were the highlights for today's show. I think we might have some time for any questions. You can definitely hit us up, 513-630-2664, or send us an email, shepherdwm.com. Be glad to address any viewer questions.
Can certainly drop a chat on the live stream as well.
Yeah. And on top of all that fun stuff coming out next week, we also have the NFL draft.
Oh, I know that's probably a holiday in your house.
Man, it really is. Well, for everybody here in Cincinnati, actually.
Oh, yeah, right.
Right.
I forgot how much we love the Bengals.
So we have the 28th overall pick in the first round. I think a lot of people are calling for a tight end there.
Not a lineman, huh? To protect Joe Burrow.
Well, they got the big guy, Orlando Brown, 4 years, $64 million contract. Plus, they picked up some good guys last year in free agency. They got hurt in the playoffs.
Yeah.
Which is unfortunate. So we'll see. I think the line looks pretty good with the free agents that they got. I think they'll probably end up picking up some people too, late round draft picks. But I think consensus going into the draft is tight end and corner.
Mm-hmm.
Maybe even a running back, believe it or not, depending on how the board falls, just because, you got Joe Mixon. He's got some legal problems and he's getting a little older too. As much as I've loved his career in the Bengals uniform, but we'll see what happens for him specifically.
His contributions on the field have certainly been pretty spectacular.
Yeah, so we're looking forward to the NFL draft. But yeah, kind of talking about taxes. Tax season is now over, at least for those that have filed their taxes. Some of us, like myself, have an extension.
It's not bragging if it's true.
That's right. I am going to have to write a check, so I don't want that extension to go out too far due to the interest that can be accumulated on that. But tax season's over. We had a really successful tax season for our clients. Part of what we do here for household accounts $500,000 or greater is we actually cover the cost of preparing and filing taxes.
That's amazing, because between that and what I owe every year, it sucks.
Yeah, so I think even on H&R Block, TurboTax, I haven't used it since I was in, I don't know, I might have been in high school or first years of college when I was still using that sort of thing. But those guys are still charging, $500-600 to do taxes. It's just a part of what we do here for customers. And the reason why we provide that extra level of service is truly that's how it should be done in our view. Because how could you possibly go about having an effectively managed portfolio if you're not taking taxes into the equation?
Yeah.
So part of the service, when we charge 1% for those household accounts, $500,000 or greater, part of the 1% will cover the preparation and filing of taxes by a certified public accountant. And then in addition to that, for those clients that have needs to have their wills reviewed, maybe updated, maybe created for the first time. Same thing for trust creation. We have a $2,000 credit for our clients on an annual basis to cover those costs as well. Because again, as being a certified financial planner, I cannot have a healthy conversation or a good financial relationship with customers if we're not taking into consideration the transfer of wealth. It's one thing to build it, but why would you want it to be destroyed due to estate taxes or having people, specifically loved ones, that may not be in a great position to handle a large transfer, a large sum of money all in one shot. So we can set up guardrails for all of that to make sure the wealth lasts for the next generation as well. So those are all the things that we're doing for customers above and beyond what a lot of institutions, including some of the biggest investment firms that are on the planet, right here in the United States, that a lot of them aren't willing to do all of those sorts of things. And we certainly are in a position to do that. And we got a lot of great feedback from it because clients were able to provide the information that the CPAs and the attorneys need, and that's it. Now they get to go on and go about the rest of their day, whether it's retirement, fun stuff, whether it's going back to work, raising a family, what have you. And that's how it should be done. That way they can focus on what's really important to them, which is their family, their loved ones, their time.
Yeah.
Because it's certainly something that you can waste, but you can never purchase back. So we're trying to make it very effective and efficient 100%. For customers to get everything handled in one meeting at one low cost. So a lot of great feedback for customers during the tax season. And the good news is everybody's got done on time, except for mine.
Well, your time is different than everyone else's. That's the point of an extension, right?
Yeah. No, I told the CPAs just that. I was like, don't worry about me. Let's make sure all the customers get handled here, and then we can get into my stuff.
Yeah.
At some point in time between now and October. So taxes are done, and the good news is we don't have to worry about that for a few more quarters. Hopefully, we'll have a lot more work for the CPAs to do next year as we continue to grow as a firm.
That's my hope as well. Maybe, I could get a raise and they could do my taxes. That would be awesome.
Yeah, no doubt. We'd be happy to help out in that space.
Just kidding.
Now, to wrap everything up here for today's podcast, some of the questions that I've been getting here, fairly recently from customers is, why is the Fed constantly looking at backward-looking data? Now, we've talked about this on the podcast. I've written about it many, many times. And really, really smart people, way smarter than me, Professor Jeremy Siegel, the Wharton School of Business. He's on CNBC a lot. He talked about this in detail. And if you're, you don't have to take my word for it. Just Google Jeremy Siegel and the most recent, bit that he did on CNBC. We'll talk about what I'm about ready to say here. Is that the Fed's looking at, this inflation data, and it's very lagging in the sense that 30% of the overall calculation is real estate, right? Housing, owner's equivalent rent, et cetera. Well, all that's a very lagging indicator because that CPI metric, the headline inflation number that we get first every month or almost every month, is giving an equal weighting to the prior 12 months inflation data. Mm-hmm. Whereas if you look at the actual market data using real information in the economy as it stands today, like the last 3 months, if you will, and you put that information into the same calculation the Fed does, instead of seeing a 5% year-over-year inflation number, which is still falling, you actually get a current CPI of around 3%, which is very, very close to that 2% target that the Federal Reserve is hell-bent on getting back to, which I don't disagree. I think 2% sounds great. That was always the long-term target. It seemed to work out pretty well. I don't know why 3% would be terrible, but maybe over a long period of time it could affect GDP. So I'm cool with 2% being the target. But the problem is they continue to be hell-bent on this backward-looking data, and that's the exact reason why the stock market, specifically the bond market, when you look at things like the 2-year yield, the 10-year yield, is basically saying the Fed is going to have to start cutting rates here in the not-so-distant future. Now, there's a huge debate as to whether or not the Fed's going to actually end up cutting rates before the end of this year or not, but I am in the firm belief of the data, and usually the market, specifically the bond market, is going to be the best economist. The Fed has 1,000 freaking PhDs working for them, PhD in economists. That's never a good thing, right? If you got 1,000 PhDs, they're always going to have pretty conflicting views and are always going to overanalyze every little piece of data. But how about just make it very simple, guys? This housing data, we understand, we admit that there's a major lag effect, and it's a huge component of the inflation calculation. Does anybody here feel inflation in housing? You see housing prices falling all over the place. The actual stuff to make a house, the wood, the copper, all the things are lower now. Wages are up. I get that. But it's not the reason for, any sticky inflation, because you actually see the wage numbers petering out and actually falling down. Because who's asking for a raise right now, right? If you're asking for a raise right now, you missed the boat. You could have asked for a raise easily 12 months ago, and you probably would have got it. Mm. So for all those reasons, we still believe that inflation is falling faster than consensus, which supports the positioning that we have here for customers being overweight in the technology space. So we'll all learn, firsthand what actually comes about here with inflation reports that are coming out. As we talked about, we get the core PCE, the Fed's favorite inflation measure, right here at the end of April, right before the next announcement on May 3rd. So we'll see what happens. I'm ready to pivot very quickly if I'm wrong. We'll probably go back to doing things that worked out well in 2022 if I'm wrong, but the data is suggesting that we are not going to have a recession. We might have a earnings slowdown, but it's certainly being held up pretty nicely based on the earnings reports that we're seeing. And we have not completely destroyed the employment part of the economy here. So if the Fed can get a little religion and take a little dose of reality of what's actually happening on the streets here today, I think we're going to have a hell of a good 2023. And not have to wait till 2024 to see some positive news from a stock market perspective. So we covered it all here, Ez. I think we got it. Any words of wisdom from you as we wrap this one up here?
No, I don't know what's going on.
All right. We appreciate you guys tuning in. We try to do this every 2 weeks, but you can certainly go to shepherdwm.com. We have a Friday blog that we post out there. We try to do a newsletter at the beginning of every month, so you can check those out right on the website. And then, of course, you can always send us your questions via email, as well as texting to 513-630-2664. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Hope you guys have a great rest of your day. Have a great week. And we'll look forward to doing this again in May. Take care.